Hello everyone, welcome to Module 2. In this module, we'll learn something from Chapter 2 of your textbook. So there are 3 subsections in your Chapter 2, and we'll be focusing on the Chapter 2-1, The Economist as Scientist. We'll be learning about these 2 models here, okay? And the later contents in your textbook, you don't need to worry about it. They will not be in our tests or quizzes or anything. Okay. So before you watch this video lecture, take some time to go through the chapter in your textbook, okay? And to have a sense of what are the 2 models. So the first model is called a circular flow diagram, or CFD. And this CFD model will give us a sense of how the economy and markets, flow in a cycle. And that's basically a very important model when we're talking about economics. And the second one, the production possibility frontier, or PPF, is very important when we talk about the trade chapter later. Right? So please make sure you read your textbook. So the circular flow diagram model kind of setting the stage of the game of economics, right? So first, it specifies who are the players of this game. In an economy, we have 2 groups of players, or as in the textbook, they're called decision makers, right? First are firms, and we also have households. And while the 2 groups are interacting with each other, we have some economic activities, and we have markets, and this is how an economy gets going, right? So where the 2 parties, the 2 groups of players, or 2 groups of decision makers, firms and households, they meet each other in the markets. And speaking of markets, there are actually more than one kind of markets, okay? So the first kind is called markets for goods and services, or in short, we call it goods market, which we are more familiar with, right? Because when we're, say, purchasing things from Amazon, when we are buying groceries at stores, we are purchasing or buying stuff from the goods market. And when we go to a salon for like a haircut, or when we take our pass to see a doctor, we are buying some services. So that's also following this markets for goods and services. However, there's another type of markets that we might not be quite aware of. It's called a factor market, right? And the factor market is short for markets for factors of production. So these factor markets could be the copper markets, right? And also the labor market. So where the factors of production is being traded in the factor market. What's interesting about this model is that firms and households, they actually don't see each other in one market. They see each other in both markets, okay? So in goods market, they're doing some transactions. And at the factor markets, they meet each other again and make a different transactions. So we're gonna elaborate in later slides. To start with, let's take a look at what the 2 decision makers need to fulfill in 2 different markets. So first, for households, they need to sell the factor of production in the factor market so that they could earn incomes. And examples could be they get a job. they provide labor as a factor of production in the labor market to earn wages. Or household could rent or sell their capitals, like properties, to firms so they can earn rent. Or as a owner of some businesses, they can also earn profits. And their goal in the goods and service market is to buy things for their daily consumption, right? Now let's take a look at firms. So firms need to acquire factors of productions from the factor market. They need to hire people, they need to get capitals, facilities, machines, and stuff from the factor market. And they need to sell their products in the goods and services market to earn profit. So looks like both parties, firms and households, they need both markets. So keep in mind that households and firms, they play different roles in different markets, right? They kind of exchange the roles in different markets. For example, in the goods market, sellers are firms and buyers are households, individuals like us. And in the factor productions, who are the sellers here? Individuals, us, households, right? And buyers will be firms. So in different markets, the behaviors are kind of mirroring each other of each party. But don't be overwhelmed by like the complexity of this model. We will be focusing on the goods and service market for this course. What you need to know is that what happened in the factor market is just like the opposite. Okay? Now let's put players and markets together, and then we can have this circular flow diagram. Let's see how it works. So let's pick maybe firms as a starting point. The firm's job or goals are to make profit. So they produce stuff, goods and services, and sell them in the goods and services market to earn some revenue, right? So in here, we see goods and service going to the goods market and money, revenue comes back, okay? And in the goods market, the households or consumers, they get goods and service at the expense of money. So they spend. Spendings or dollars go along the green arrows, right, from households to firms in the form of spending from the household's perspective and in the form of revenue from the firm's perspective, right? So goods and services go along the red arrow and money, dollars go along the green arrow through the goods market. Okay? And what happens in the factor market? The households, they provide labor, land, or machines, or properties to the factor market, and firms will purchase those from the factor market, right, at the expense of like rent or wage or profit. So dollar going through market of factors from the firms to the households in the forms of like wages to firms or income from the household's perspective. Okay, so if we put the two markets and both players together, we can see the dollar will keep rolling in a cycle, in a circle, right, along the green arrows. The firms will never stop like buying the factor of production, right? They need to keep hiring people, right? Not for one day. They hire people as long as the business is running. So the dollars, right, in the form of wages goes to the households, and households spend those money, and firms make revenues and they got money to hire more people or keep hiring people or buy more capitals, right? So dollars keep flowing like that. And goods and services also never stop running in this circular flow diagram. So this diagram is giving you a sense how the economy never stopped running. Because we have these two markets and players following the rules of markets. So we have a healthy and non-stop economy and everybody is happy in this world. Okay, so now we're going to move on to the next model, the production possibilities frontier, or PPF. Some textbooks call it production possibilities curve or PPC, but we'll just go by PPF following our textbook. But you might need to know they are exactly the same thing. All right, so what does PPF mean? Let's take a closer look of like the name. The first P stands for production. So we know it must relate to the firm's side, right? Like we just covered. There are two parties. Either you are a firm or you are a consumer in an economy. So PPF somehow describes some behavior or decision-making process within the firm, okay? In possibilities, is saying that this PPF graph will give you information on under different scenarios. Will give you different possibilities, all the possibilities of production. Okay, what does that mean? So as you can see on this graph, right, we assume a firm can produce two different things with the given resources. And those resources could be labor, it could be capital, inputs, raw materials, all those. So once the firms know what they have, they can make decisions, right, on how much each product they're going to produce. So in this example here, we assume a firm can produce computers as well as cars. So they need to make decisions, right, between how much computers they could make and how much cars they could make. And of course, the more computers they make, the less resources left for cars, right? And if they put much of their resources in car production, then they can make very little amount of computers. And lastly, frontier. Why do we go by the name of PPF? Because frontier is giving you a sense that this is a kind of best scenario and this is a limit, right? Because as a firm, you cannot really go beyond this PPF. You cannot go beyond your production possibilities frontier. And we will elaborate why, okay? Now let's talk about how to set up the PPF model, how to draw a PPF. Okay, we'll go by the example from last slide. Assume we are a firm that produces computers and cars, and we make decisions between like how much computers and how much cars shall we make. Okay, so we put computers along one of the axes, the y-axis, and we put cars, quantity of cars to produce along the horizontal axis. Okay, so you can draw a coordinate system and put quantity of computers and quantity of car productions along the two axes. Okay? And remember that PPF shows all the possibilities of production. Okay, and we will start with the extreme cases. So now let's first consider, what if we put all the resources in computer production? How many computers can we make? So in the example, this number is given as 3,000. Okay, it's given information. We can make 3,000 computers if we put all the resources in computer production only. So in this case, we'll have 0 resource left for car production, right? So one combination, one possibility is already available now as a extreme case, right? When we put all the resources in computer production, we have 3,000 computers and 0 car. Okay, so this will refer to a point along the vertical axis, right? So we put this 3,000 here. This intercept would represent 0 amount of cars. And similarly, if we put all the resources in car production, we can make 1,000 cars. This is just a given number for the purpose of like a demonstration, okay? So we know if we put all the resources in cars, we got 1,000 cars and 0 computers. Okay, that's what this intercept along the car axis means. That is another possible combination of products, 0 computer and 1,000 cars, which kind of makes sense, right? Because you see this with the same amount of resources available to the firm, you can either make 3,000 computers and 0 cars or 1,000 cars and 0 computers. That makes sense because obviously producing cars are more expensive, right? If you use the same amount of resources in car production, you'll have less cars than putting them all in computers. Now that we have the 2 extreme case possibilities, so what are other possibilities? Take a second to think about it. Remember, we kind of going over the trade-off principle? Because firms facing limited, scarce resources, so when they are making production decisions, they have to trade off between all the possible products they could have make. Okay? So usually a firm will not put all the resources in one product, right? So they usually would not end up at those intercept points. They would end up with a combination of computers and cars, right? So that would be some point, along this curve, right? This curve is kind of downward sloping because when you are start from the point of 3,000 computers and 0 cars, right? You start to make less computers, right? Then you start to make more cars. So this curve goes downward sloping until you reach the point you're producing more and more cars when you go this direction, right? And less computers when you move down this PPF here. So basically PPF connects, right, the 2 extreme cases and gives you all the possible combinations, and is downward sloping to reflect the trade-off, right? When you are making more cars going this direction, going to the right, you're making less computers, so you're going down this PPF curve. PPF stands for the most efficient levels of production, which means you cannot do better with the resources given. You cannot go beyond your PPF. But can you go under your PPF? The answer is yes, right? So say this point D here shows you can produce, of course, 1,000 computers with 300 cars. And at this point D here, you are not utilizing, you're not using up all your resources, right? So this is possible, it's feasible, but not the most efficient way to utilize your resources. If you're at point D, you still have remaining resources to produce more and make more profit, so you would like to go further, right, to produce more until you reach one of the points along your PPF. So F, A, B, and E represent points that you're producing at a efficient level. So all F, A, B, E, those points are the best you can do. But you still have different options, different possibilities as you are utilizing your resources. But you cannot really get to the point C because those will require more resources, right? If you start from this point, this intercept here, and you want to produce more cars, like say at the C level, almost 600, then you have to produce less computers. You cannot make 3,000 computers and maybe 580 cars at the same time. If you want to make 3,000 computers, you can only afford 0 cars. If you want to make, say, 580 cars, then you can only make slightly above 2,000 computers. So you're stick to either along your PPF or underneath. Only points along your PPF or underneath or inside your PPF are feasible. Okay, the difference is along PPF you got efficient combinations, and below or inside PPF you got feasible but inefficient production combinations or production possibilities. And any points outside PPF is just not feasible with your current resources given. So what if a firm wants to just produce more? Say if they want to go for the C combination, one way is through like R&D activities, right? If they got some advance in technology, say related to the computer production, then they can actually raise like the maximum amount of computers to this 4,000, and doing that, it would draw a new production possibility frontier as shown as the red curve here, right? So in that sense, they can achieve the point G, along which they could not achieve with the old PPF. So technological advance will shift your PPF further, right, beyond your old production possibilities. And when that happens, you can actually achieve the combination you cannot afford before. So this graph shows a technological advance related only to computer production. There could be some improvement in technology that affect both, right? Both production procedures. So assume something happened that an economy-wide improvement in technology happens. So that would shift the PPF outward, and you would have higher computer production and car production with the same amount of resources. Okay, so you have a new PPF on top, above your old PPF, and you are producing along this curve. So when that holds, then all the points, right, underneath this new PPF or along this new PPF are feasible now. So that's why firms nowadays and in the past, they need to spend money in R&D activities, right? So they can keep improving their technology and they can produce more and more to achieve higher and higher profits. Okay? So that's all for chapter 2.